Assalamualaikum and hi to everyone, and especially for my beloved lecturer, Madam Nadia Farlina. Today, I would like to share about the differences between Islamic finance and conventional finance. First of all, what is Islamic finance and conventional finance? Islamic banking, also referred to as Islamic finance or Sharia compliant finance, refers to finance or banking activities that adhere to Sharia or Islamic law. Two fundamental principles of Islamic banking are sharing profit and loss and the prohibition of the collection and payment of interest by lenders and investors. Conventional finance is a home financing scheme offered by financial institutions or banks which are not guaranteed by government agencies. It is a transaction based on interest rate for saving surplus or deficit spending units to loan or borrow funds in financial markets. The value propositions of Islamic finance is different from conventional financial intermediations. There are a number of notable differences between the two industries. Sharia compliance is the defining characteristic of Islamic finance and therefore the basis for its value propositions. Islamic finance industry is not averse to profit making. Its value proposition is more of bringing benefits to doorstep of their consumers in a mutually beneficial manner through partnership modes of financings. The other value propositions of Islamic finance is firmly rooted in the Maqasid Sharia, traditionally involve ethical investing and green businesses. At consumer level, one may ask whether the consumers of Islamic finance products are reasonably protected from financial market manipulation. The Sharia compliance of the structure related to a large extent to the value propositions of Islamic financial intermediation. The weakness of the regulation in some countries has unfortunately created an opportunity for some Islamic finance institutions to go haywire with special reference to the prudential management of clients' funds. The above recommendation is meant to enhance the value propositions of Islamic finance as a global industry. The value propositions of the conventional finance is geared toward customer-friendly customer service that are meant to attract more customers with the ingenious objective of profit maximizations. Then, if the value proposition of conventional finance involve socio-economic benefits for the consumers, there wouldn't be any needs for socially responsible investing. Now we move to the structure of Islamic finance and conventional finance. Islamic bank is supposed to be set up is based on the theory of sources and application of funds. There should be a single flow between the deposits and the financing investment. Use of fund, this means there is no distinct function. It is a single function where customer deposits or investment pool is used to fund financing portfolio or deploy into investment instruments from which returns are derived and recognized. Once the returns are determined, these returns are shared between the bank and the customers. This profit-loss sharing structure demands a different way of managing the bank. Although not all Islamic banks are able to successfully pull this off 100%, especially when the Islamic banks are under the parentage of a conventional bank. For a conventional banking, the purpose of setup is to collect deposit and to give loans. This is the shareholders' understanding of what it should be. Two very distinct functions in example, collect deposit and give loan. And the arrangement is managed by a treasury function which tries to balance the returns to shareholders' fund. The processes in an Islamic bank and conventional bank are also different, simply due to the structure of which it has been set up. There is a broader requirement for oversight and research required to ensure the Islamic products and service meets Sharia requirements, a lot more layers to comply with, a lot more details needed. Islamic financing avoids interest-based transaction, or we call as riba, and instead of introduce the concept of buying something on the borrower's behalf and selling it back to the borrower at profit. Its operations are essentially based on a certain set of moral and ethical principles that determine what is viewed as a morally right, and implying actions and transactions that promote public good, and wrong implying actions and transactions likely to be against the public good, while prohibiting the receipt and payment of interest is the nucleus of the system. It is supported by other principles of Islamic teaching, advocating individuals' rights and duties. The Islamic financial system is not limited to banking but cover insurance, capital formation, capital markets, and all types of financial intermediations. In conventional financing, lenders lend to borrowers to make a profit from the interest charged on the principal amount. The major financing objective of the conventional banking system is to achieve maximization of shareholders' wealth through interest differential. For property loans, borrowers pay an interest on the outstanding principal amount. Interest rate can be a fixed rate or based on a floating rate. Since the contract is not based on an absolute value, for example, the sale price, the sooner the borrower can pay down the principal, the cheaper the amount of interest paid. A financial instrument is defined as any contract that gives rise to a financial asset of one entity and a financial liability or equity instruments of another entity. Islamic financial instruments are asset-backed and deal with tangible. Another difference between conventional and Islamic financial instrument is the relationship. In Islamic financial instruments, the relationship is commonly some form of partnership, agency, lessor or lessee, or buyer or seller. In Islamic financial instruments, the financiers must bear some risk in order to profit. Islamic financial instruments are governed by divine law and ethical principles. Lying, cheating, excessive profiteering, hoarding, monopolizing are all prohibited. Islamic financial instruments are governed by many contractual rulings. For example, Islamic financial instruments must be free from gharar, which is uncertainty. Hence, contracts cannot be pledged upon uncertain events or forwarded to future dates. For conventional financial instruments, deal in intangible assets. Intangible assets represent legal claims to some future benefits. The typical benefits is a claim to a future cash. In conventional financial instruments, there is generally a relationship of borrower or lender. For example, in conventional bonds, the issuer are regarded as the borrower and the bond purchaser are in reality lenders. Risk-taking is also a major distinction between conventional and Islamic financial instruments. In conventional instruments, the financiers do not share the risk. Risk is transferred to the client. Conventional instruments are not regulated by any divine law or ethical guidelines. Profit can be gained despite lying, excessive profiteering, and other unethical practices. Then, conventional instruments do not have many contractual ruling and principles to make them valid. There are several types of Islamic finance products, such as murabahah, sukuk, istisna, and ijarah as a fixed claim instruments, while mudarabah and musyarakah are equity instruments. And conventional finance also offered a lot of products like term deposit, saving, current accounts, leasing, and loan contract. Islamic finance can help by assisting financial inclusion, reducing the impact of harmful products, and practices also encouraging stability in investment. In conclusion, Islamic financial instruments must be asset-backed, involve risk sharing, and must work within the framework of Islamic law. In contrast, conventional financial instruments are bereft of the formal guidelines and principles.